Okay, so it's we got a couple more people coming in, but let's get started. So welcome everybody. Thank you for spending the next 45 minutes with myself and John Starling. My name is Michelle Fitzpatrick. I'm with Northern Bank. Before we get started, I want to just do a quick disclosure in that this is being recorded. So if you don't feel comfortable and you don't give us permission to record, simply disconnect, and we will be sending this recording out after we complete it today. However, if you do, you are consenting to be recorded, both your voice and your image. So that's my little disclosure. So again, my name is Michelle Fitzpatrick. I'm with Northern 1031 Exchange. We do these webinars monthly. So we try to hit on topics that are interesting to people, that we're seeing a lot of questions asked regarding short-term rental exchanges. So this is the time frame that people are thinking about doing short-term rentals, whether it's on the Cape or down in North Carolina or up in New Hampshire or down in Florida. So that is what we're going to be discussing today. I am joined here today with my associates, John Starling and Sarah Starling, and I will let them say hi.
Hello.
Okay, so Sarah is my daughter. She's been working with 1031 exchanges for about 14 years now. She's a certified exchange specialist, and Michelle and I have been working together for about 10 years.
10 years.
Yeah, it's flown by too. We love Michelle, and we're the southern contingency of the northern 1031 company called Northern 1031 Exchange, which is a wholly owned subsidiary of Northern Bank and Trust. And Michelle, you normally pitch that, don't you?
That's right. That's right. So, well, do you want to get started?
Absolutely.
Perfect. So we are talking, like I said, about short-term rental exchanges. And anytime we start our exchange seminar, we always talk about really the basics of 1031 exchange. So first, what is a 1031 exchange? It's an IRS code. And this is the code I have up on your screen. And it simply says, no gain or loss shall be recognized on the exchange of real property, which is held for productive use in a trade or business, or for investment, if the property is exchanged solely for real property of like kind, which is to be held for either productive use in a trade or business, or if it's held for investment. So that's it. That is the 1031 code. And, you know, we highlight real property because it really only allows you to swap real property now. Back before 2017, you were allowed to swap personal property, cars, airplanes, boats, things like that. That is no longer the case. So it is simply real property for investment use or business purposes. And, you know, people talk often about selling their property, and, you know, they may get advice and say, well, just sell your investment property, take the 15% hit, pay the taxes, and just move on. And what they don't realize is that it's more than 15%. And these are the taxes that you'll face whenever you're doing a 1031 exchange. There's the federal capital gains tax, and that can be anywhere from 0 to 20%. What we find when people are selling in Massachusetts, they most often fall in this 20% bracket because it pops them up over the income level of the 15%. So most times when we see people selling in Massachusetts, they're in this 20% tax, federal tax. The other federal tax is called NIIT tax, or net investment income tax, and that's 3.8%. So, you know, just on the federal side here, you've got 23.8%. We've got the federal recapture of depreciation. So if you've owned the property for a long time and you've depreciated it, which you can depreciate residential properties 27 and a half years, you can depreciate commercial properties for 39 years. But if you've held this property for a long time, the IRS gives you a bonus it gives you a depreciation benefit every year and allows you to, take money off your taxes. But when you go to sell it and cash out, they recapture all the depreciation that you took at 25%. So that can be fairly substantial for people who have held their properties for a long time.
Michelle, just to butt in, if people don't depreciate their property, the IRS still imputes depreciation. So regardless of whether they depreciated or whether they did not depreciate, they're still going to pay the federal depreciation recapture rate on what they should have depreciated in the first place.
Yeah, that's a great point, and it's unfortunate, but that's a great point. Thank you.
Yeah, it's always best to depreciate no matter
Yes.
what. Yeah.
Yeah, absolutely. And believe it or not, some people don't. We've had people that say that they haven't and haven't treated it as, treated their investment properties the way they should. So in Massachusetts, and I'm just giving you an example of Massachusetts because that's where I'm based, but Massachusetts has a state tax of 5%. Some states have no tax, but some states like California have a tax up to almost 14%. So state tax varies obviously from state to state. Massachusetts has a 5% state tax, but then they started a millionaire's tax. It was about 2 years ago, I think now. And unfortunately, a lot of our customers fall into this millionaire tax. For every dollar over $1 million that's earned in income is going to be taxed at 4%. So in Massachusetts, if you sell a $2 million property, you have $1 million that's going to be taxed at 9%. So as you can see, it adds up really quickly. It's certainly more than 15%. We estimate typically when we're talking to clients, we're estimating typically around 30%, 30 to 35% of tax.
Correct.
So John, if you want to kind of go through how the exchange works, like how a forward exchange works.
So step-by-step procedure, you list your property, of course, to sell it, and then you find a buyer. Once you've found a buyer, then the buyer will sign a contract with you, and that's when you engage us, because the qualified intermediary, the little man in the middle with the tie, I'm not wearing mine today. So normally I do. That qualified intermediary will sign an agreement with you as the taxpayer, and you're up at the top there where it says taxpayer, and there'll be an agreement that's signed prior to the closing saying that we will intercede and be the intermediary so that you will have someone to exchange with. Remember what the exchange code says. The code subsection 1031 says that if you are exchanging property. Now, the difference between exchanging and selling is that if you sell to one person and you take the money and then you go to another person, you've sold with a tax event, and then you've bought a new investment property, but you get no tax break because you did not select a qualified intermediary and engage them to act as the person that you exchange with. So that's what the exchange agreement does. And then the exchange agreement takes assignment of the contract that you have between you and your buyer, so that at the closing, when the closing attorney disperses the funds, he will disperse the funds to us because we have taken assignment of your contract. You have basically sold your property to us, and then we sell it to the buyer. The buyer pays us the proceeds, and we hold those proceeds until a seller appears, until you find a seller that wants to sell you his replacement property. I should say until you find a property that a seller is willing to sell you, and then you write a contract for the purchase of that property, and then that property contract is assigned to us, and at the closing we provide the funds and buy the property from the seller, and the seller can directly deed the property to you as the taxpayer, and that completes your sale.
That's it. You have 180 days total to do this, which is usually not a problem. The 180 days is the exchange period. So from the time that you sell, the time that you close on your relinquished property, you have 180 days to take title to your new property. Where the problem really is, and I always tell people, I think one of the hardest parts of the exchange is the 45-day identification period. If you do not have a property teed up and ready to go when you close on that first leg, that relinquished property, you only have 45 days to identify what you want to purchase. And the IRS has very strict guidelines on how you identify. So you can't just grab say, I want to live in this complex down in Naples, Florida. You have to be very specific and give the address and the unit number and the value of that property. So we're not going to get into too much details about identification rules, but there are certainly rules that you do need to abide by. Time frame is the number one thing that you have to consider. If you do not identify, if you get to your 45 days and you don't have a property that you want to identify or that you think you can secure to complete your exchange, you simply don't identify, your exchange fails, your proceeds get returned to you, and you just pay your tax when you file your taxes. That's kind of the worst case scenario. So
no penalty if you can't find that replacement property, except for the fact that you're going to have to pay the tax, which you were hoping not to have to pay.
Yeah, and I'm going to tell you a really, really quick story, but I had been talking to a real estate agent since October. He had planned on selling his property in February, and we had been talking. It was, he was going through every scenario, and I said, at least start your exchange. And he's like, nope, I'm not going to do it because I don't have a replacement property. The one that I want, I cannot get. So I'm not even going to bother exchanging. He sold on February 18th. He sent me an email yesterday and said, hey, is it too late? My property that I wanted to buy just came on the market unexpectedly. And I said, yep, it's too late. And it was a $1.8 million property that he sold. So it was start the exchange. If you're even questioning it.
What was his problem? He didn't want to pay
He had a very specific property that he wanted to buy, and he couldn't get it. And it was an old woman, and she ended up
agreeing
on the
to
market.
sell.
Yep.
Right.
3 weeks after he sold.
When he closed on his relinquished property, he just failed to set up the exchange. So he had already accepted his money.
Yep.
Shoot.
Yep. So I know I was so upset when I got his email yesterday. So, but that happens. So
they always ask me a few days later after they've accepted their money, can they rewind or go back and create the exchange? And, the only way that could even possibly be done is if you haven't cashed the check and the attorney agrees to take it back and change the settlement statement. And, it can be very cumbersome. So generally the answer is once you've accepted the proceeds from the sale, it's going to be too late.
Yep. So, and I'm going to answer a question and just kind of make a statement while I'm talking about it. But whenever you do an exchange, whenever you sell a property, your goal is to always buy a replacement property of equal or greater value and use all of your exchange proceeds. So that's really the goal of any exchange in order to defer all of your taxes. So the question that was asked was, what happens if the target property is over the sales proceeds? For example, the replacement property is $1.5 million. Can you use $1 million from the proceeds and take a mortgage for the $500,000? And the answer is yes. If you sell for $1 million and you buy for 1.5, you have to use the whole $1 million to purchase, and then you can take a note or a mortgage for the 500,000. So that was a good question. John, do you want to just take some of the things that do not qualify for 1031 exchange?
Oh, so Michelle, yeah, on that example, so you're taking it at today's prevailing interest rate.
Yeah.
So yes. if your relinquished property has a mortgage, and you were able to secure the mortgage back during COVID, like at a 4%. The new mortgage that you would be taking with the exchange and the sale of the property would be at like the 7% or 8% today's interest rate.
Yep.
Okay.
Yep.
Okay.
Go ahead, John.
So these are properties that are not 1031 exchangeable. So Sarah, let's just alternate on these. Your personal residence, obviously, you cannot 1031 exchange because there's a code called 121, which is your primary residence exemption that allows you to sell your primary residence without paying tax. If you're married, you can make up to $500,000 without paying tax, and if you're single, you can make up to $250,000 and not pay tax.
Yeah, I had a runner friend yesterday tell me that you can only do that one time in your life, and I got so upset with her because we've been chatting and talking about work for years, and I had to remind her that you can do it every 2 years, right? You can sell a primary and take the 250 or 500 exemption. So also exceptions are vacation or second homes used primarily for personal use. There is kind of a hybrid situation where people call their investment properties second homes, but they don't actually, by the time they're ready to sell, they're not staying there much and they're renting them out a lot, so they can actually qualify for investment properties. So whenever you have someone that says, I want to sell my second home, might be that it is an investment property. They're just calling it a second home. Stock and trade or other property purchase primarily for quick resale. So if you're a flipper, you can't do flips, or if you're a builder, unless it's your own inventory that you're keeping and holding, you can do that. You can be a builder or a flipper and have long-term holds. Stock, bonds, or notes, that's kind of obvious. Those are not real estate. Oops, sorry. We were supposed to alternate.
That's okay. Not a problem. Keep going. You're doing great.
So other securities or evidences of indebtedness or interest. That would be a note, a note, take back a note.
Yeah, like a seller's note.
Not real estate. Interest in partnership, so you cannot buy into an LLC. You have to buy into the underlying real estate. And certificates of trust or beneficial interest.
Yep. Thanks, Sarah. You said it better than John.
Sorry, I got on a roll.
So let's get into the meat of what we're talking about today. We are talking about short-term rentals and really what qualifies a vacation home or a second home, or what some people may be like Airbnb-ing. What qualifies that to be exchangeable property? So the IRS is pretty clear in saying that second homes do not qualify, that are used exclusively for personal use. So what the IRS did was they created a RevProc 2008-16. It is a safe harbor. And it says that the IRS will consider a dwelling held for investment if these certain requirements are met. And the first requirement is that both the relinquished property, the one that you're selling, and the replacement property, the one that you're purchasing, they need to be held by the taxpayer for 24 months. So your relinquished property has to be held at least 24 months prior to sale, and the replacement property has to be held for at least 24 months after the purchase. And within each of the 12-month periods that the property needs to be rented for a minimum of 2 weeks per year. For a minimum of 2 weeks per year, 14 days, to a unrelated party. Now, if it is a related party, meaning it is a son, a daughter, a brother, a sister, mother, father, if it is a related party, that related party needs to rent that property at fair market value, and they need to show it as their primary residence. So it's getting away from John renting Sarah his second home for 2 weeks and then not renting it the rest of the year, and saying, yep, it qualifies. So that's the requirement. And the dwelling cannot be used again for the first 2 years cannot be used for more than 14 days per year or 10% of the time that it is rented. So you have to rent the property and you have to restrict your usage.
Now,
John,
just to mention this revenue procedure, Michelle said it was a safe harbor, and basically what that means is that it might a property that has different aspects to it than these may still qualify as an investment property. But if you follow these rules exactly, then the IRS will not and cannot question whether it is a second home versus an investment property. So if you follow these rules, it will be considered an investment property no matter what. If you don't follow these rules, it still may be considered an investment property. Like you could use it for more than 14 days a year. And it's if you are there for purposes of maintaining or improving the property. So, for instance, your family is at the ski condo that you've got at your local ski resort, and they're skiing, and you're there painting the bathroom and doing a spring cleaning and getting it ready for, the next tenant, then you're working. And if you're working an 8-hour day, then the family can be there and you can be there, and it's not counted against your 14 days of personal use.
Yeah, that's exactly right. And we get that a lot. I feel like I talk to a lot of landlords that are doing Airbnb, and they say that they spend every time that they're up there, they're doing something, constantly getting it ready for a new tenant, constantly doing improvements, constantly doing landscaping. So that's very common. So, that's a very common thing. So I think maybe we can talk about that a little bit. What is fair market rent? People ask that all the time. Like, what if I rent it for lower than that? And John, do you kind of want to talk a little bit about what fair market rent is? I mean, really, we should be deferring to like a real estate agent to try to establish what a fair market rent would be.
Yeah, I mean, you can rent to to one of your friends for less than you might rent to someone off the street, but you have to keep it within a parameter. So it needs to be, no more than 20%. And I'm just taking a figure out of the air, but I think most CPAs would say, if the average property of your square footage in your location is renting for $2,000 a week, or let's say $5,000 a week, if you rent it for $2,500, then that's not fair market value. If you rent it for $4,000, then maybe you're okay.
Yep. And I think you already kind of talked a little bit about what personal use looked like. So, again, you can use your property for 2 weeks per year for the first 2 years, for personal use. And that simply means the time the taxpayer utilizes the property just specifically for enjoyment purposes. And that is the maximum, that 14 days. However, maintenance usage does not account, maintenance usage, I guess we call it, that is not included in your 14 days. You have an unlimited amount of maintenance you can do on the property, or maintenance time you can spend in the property.
Got to be an 8-hour day though, right?
Right. Yep.
Can't just go in and fix the cabinet.
Yeah. And I think one of the things that people always ask is, well, how would the IRS know? How does the IRS know if I've used the property for personal use or maintenance use? And, what's your kind of standard response?
Well, the IRS has more power than the FBI, right? They can tap your phone record if they wanted to. They could ask your neighbors. I mean, if you got into an audit situation, and it's like it's all self-reporting, so it's better to be do the the thing that they're, that's part of the rules and the regulations of the code.
Yep.
Better
And
to
I
stay
always-
and not worry about it,
Right. And I always tell people too, I'm like, keep a log of what you've done, keep a receipts of, the number of times you've gone to Home Depot and Lowe's and, take pictures, just keep a log for the first 2 years and that would suffice. So that
Yeah.
would be certainly helpful.
For sure.
I just, I'm old school, so I tell them to go get one of those old fashioned pocket calendars and throw it into their pocket of their car and just keep it there. And then when they go to the second home / investment property, they can make notes in that little pocket calendar. Then if they get audited, they can tell the IRS agent says, well, I noticed that you've been there quite a bit. And then you can say, well, yes, I have, but let me show you my calendar. And this is what I was doing on this weekend. And this is what I was doing during this other week. And this is what I was doing. And you keep your receipts from your hardware store and stuff like that right in that pocket calendar, in that little booklet. And you just keep it somewhere handy in your suitcase or either in your car pocket if you're traveling to the second home by car. If you're flying, then keep it in your suitcase. And so it's always there. And you can just do that for the first 2 years. And after that, you don't need to keep any records.
That's right. And 2 years goes by really quickly.
Yeah.
The older I get anyway.
Am I on?
Yeah. Hi, Bob.
Hi. The previous slide, when you're talking about putting a vacation home into a 1031 program, there was a requirement of how much usage that you had. Yeah. It couldn't be more than 14 days. The property I was thinking about putting in has a HOA bylaw that precludes any kind of short-term rental. Are there any exceptions that you're aware of that would still allow me to put that property into an exchange?
I mean,
you could do long-term rental. You don't,
Yeah.
it's not you can do, it's 14 days or more. So does the HOA allow you to do a long-term lease?
Yes.
Okay,
Yes,
well,
but
that'll work.
it has to be like a month or more rental period. So we don't allow Airbnbs or any of those kind of rentals that you would find on an app. But it is a house. It's actually up in the state of Maine that my wife and I are thinking about putting it into an exchange and then using the proceeds for that to buy the property in the Outer Banks.
Yeah, but it's telling you that it's not saying that you can't rent. Your HOA is not saying that you can't rent. It's saying that you can't do a short-term rental. So the vacation rental, you can certainly rent. You can rent, they're down in Florida, they rent them for the season. All the snowbirds from Boston go down to Florida and rent for 3 or 4 months. So that's.
I'm sorry, I don't think I'm asking the right question. Can I take that home that we already have but has never been rented and put it in the exchange?
It has, you should want to rent, you'd have to rent it leading up to the exchange for the 2 years leading up to the
So if I wanted
exchange.
to do it this year, I wouldn't be able to.
If it hasn't been rented, no.
It's never been rented because we're precluded from doing that.
But
You're
you're
not,
not,
though.
because you could rent it for 30 days, right? At a minimum.
Yeah, you're not.
So find yourself
right.
a 30-day tenant.
So you're saying if I did that in 2 years, I'd be able to put it in the program?
Correct.
Yeah,
Correct.
okay. Well,
Now-
I can't do it now,
Now there is, I don't think you're completely precluded from including it in an exchange if you haven't stayed there for more than 2 weeks a year for the last 2 years.
I lose on that one too. We're up there all the time.
Yeah. So that the preponderance of any one item that is required under the safe harbor might not disqualify you. How do you put it on how do you file it on your tax return? Do you file it under your Schedule C as a second home, or do you put it on your Schedule E as an investment property?
C.
Yeah. So it's clearly, you just cannot, you have to start, you could start in 2024 because you haven't filed your 24 return yet.
I already have. That's
Okay.
done too.
Well, then you could start in 25 and rented out for at least, that a month, if depending on what your HOA agrees to, and then, you know, dial back your personal usage,
Right.
so that you're not using it more than 2 weeks a year unless you're there for the purpose of improvement or maintenance.
Okay. Thank you.
Yep.
So I wanted to talk really quickly about what a related party is. So a related party would be deemed to be personal use if the taxpayer had, it would be their spouse, their children, their siblings, and their ancestor of linear descent, grandparents, grandchildren, that way. So again, related party would have to, if you were renting to a related party, they'd have to use it for their primary residence, and those are who related party is. Now, an unrelated party, or people that are not considered related, would be aunts, uncles, nieces, nephews, step-parents, domestic partners. So even if you're not married, if it's your boyfriend, your girlfriend, even if you're living together, that is considered an unrelated party. So I just threw that in there just to note.
Yeah, and the spouse of a related party, like your brother-in-law or your sister-in-law or your mother-in-law or your father-in-law, those are non-related parties.
Oh, right. That's right. I should have included that. That was a good call, John.
Yeah.
So, and I thought it would be, actually, we have another question. If the tax rate is 20% today, and I choose to do the 1031 exchange and then sell the property later when the tax rate is 25 to 30%, the tax rate on the capital gains will be 25 to 30%. Yes, so you're going to be taxed on whatever the tax rate is on the time that you sell.
Well, the next time you sell, you just need to do another exchange.
That's right.
You're always going to stay in real estate.
You got to swap until you drop.
Swap until you drop.
Yeah.
Yeah.
Yep.
I mean, why would you want to get out of real estate? I mean, when you sell now and you defer the gain, when you sell the next time, you're going to just defer the gain again. You're just going to have more gain to defer. And next time, maybe you're going to buy 2 properties instead of 1 because you've got a bigger appreciation and more equity to use. And you're going to continue to grow your wealth until you pass, and then your heirs get a stepped up basis. So, I mean, real estate is sheltered all the way through your whole life. And you don't have to own real estate that you have to actively manage. When you get old, like Bob and I.
John.
Hey, Bob. When you get old like us.
I had to unmute to say, speak for yourself, buddy.
Hey, tenants, toilets, and trash. That's what we don't want when we get older. We're done. We're tired of tenants, toilets, and trash. So what do? Well, we just invest in other types of real estate that we don't have to be actively managing, like triple net leased properties, commercial, or DSTs, Delaware Statutory Trust. So there are other investments that you can continue to swap until you drop. And then your heirs, of course, will get a stepped up basis. They can sell the properties that you owned at your death and pay no tax. Of course, their step up basis goes to the date of your death. So if they hold it for 3 or 4 years after your death, then they would have to pay tax on the difference between what the value of the property was when you passed and the value that it is at the time that they decide to sell later on. So
yeah, John, I think you just answered the next question, because Hector asked the question on inherited properties used in an exchange. Does the benefit continue until they do not use a 1031 exchange? So Hector, I think John just answered that. So the day of passing, you get that step. The inherited property is stepped up to the heir, and then they can continue to exchange it, but their basis is going to be the value of the property on the day of the death or the day it was inherited.
There would be no tax if they sold it after your death.
I know, but if they sold it years after, if they sold it 10 years after, 20 years after, that basis is going to be
yes,
the day of the death.
Right.
So
exactly.
I thought it would be fun. Sorry, we've been digressing just a little bit, but I did want to get back to the vacation rentals and kind of talk a little bit about a case that was tried and, an exchange that was questioned by the IRS, and the exchanger, they disqualified the exchange. So in the case of Barry E. Moore in 2007, the IRS questioned the exchange, and the taxpayer, and these were the facts of the case. The taxpayer, one, never rented or even attempted to rent the property. The taxpayer deducted mortgage interest as the home mortgage interest expense rather than investment interest expense. And the taxpayer did not take and probably did not qualify for depreciation or any other tax benefits associated with the investment property, including deductions or maintenance expenses. So just like we were talking with Bob, this property has been treated as a second home or a primary residence the entire time. It was never treated as a rental property. The IRS questioned it, and they disqualified the exchange. So these are some planning strategies just to help show that the property is in fact exchangeable, it is in fact investment property, and it will in fact qualify for the safe harbor. And to substantiate your investment intent, to report rental income in your attempts to rent the property. There are some properties that are not rentable. People may try, and for whatever reason, it may not be rentable. So show those attempts to rent the property. And show your attempt to convert it from a second home to a rental property that's held for investment. Treat the property like it's held for investment on your tax returns, filing it on your Schedule E as opposed to your Schedule C. Again, we're kind of answering these questions that Bob posed. Ensure that your homeowners association has a rental-friendly policy. There are some homeowners associations. I own a second home, and my HOA does not allow rentals at all. So I cannot ever show it as investment property. When you're obtaining finance for your investment property, make sure that you're not trying to take advantage of that discounted interest rate that the primary residence or your second home offers you. Investment properties are typically higher interest rate, and but you need to take mortgage or financing for an investment property. And then, like John and I were talking about, keep a log of your personal usage, keep a log of your maintenance usage. Those are all planning strategies that you can have in order to show that this is an investment property and would qualify for 1031 exchange. Anything
Good
to add to
job.
that? Okay, good.
Good job.
So we're kind of nearing the end. We really already talked about the primary residence tax exemption. Sarah touched on that and John touched on that. So we're going to skip over that, and we're going to talk about whenever you hire a 1031 qualified intermediary, what you want to look for. So if John and Sarah, if you want to kind of talk a little bit about what we do and what makes us different, and when you are hiring, even if you don't hire us, what you want to look for.
That was a good question. Whoever had that question.
Let's see. You need to get a qualified intermediary that understands in depth Section 1031. We've been involved in exchanges for over 25 years and have helped thousands of people, save millions and millions of dollars over the course of these last 25 years. And we've been involved in all kinds of exchanges, and we're very suited. You can't just rely on the internet because you don't know the level of competence of the qualified intermediary. So important that you select an intermediary based on a recommendation from a CPA, real estate closing attorney, a good real estate realtor, or your or your favorite banker that knows about real estate and understands the concept of 1031. That's one thing. Then, of course, reputation is very important because you're placing your money with these people. And there are very, very stringent guidelines when you place them with a company like Northern 1031 because we're a wholly owned subsidiary of Northern Bank and Trust, and so we have to operate under the Securities and Exchange Commission rules and regulations, also the banking rules. And, it's very, very important that you have good regulation. What else?
Talking a little bit about the funds and how they're held and, we get people that call, I get people that call, that they'll see our ads online and they just call and say, what's your price? And I'll give them what our fee is. And, they'll say, well, I can do it for $350. I saw somebody online. And, just beware of the people that are charging $350 to take your money. You're literally putting your money with somebody that you don't know. So we are a bank-owned qualified intermediary. We are regulated. We are audited. We have fraud protection in place. We have procedures in place for our employees. We have procedures in place for our funds transfers. So those are all really important components whenever you're doing a 1031 exchange. Obviously, that is important, just as important as the competency of the qualified intermediary that you're working with. So,
Federation of Exchange Accommodators is our trade association. You wouldn't want to go with a company that wasn't a member because the Federation of Exchange Accommodators has a code of ethics and a requirement, and they have requirements for becoming a member, so that they try to protect individuals through that process as well. So I think that that's another important factor. Make sure that any QI that you decide to select is a member of the Federation of Exchange Accommodators, which is our national trade association.
That's right. So I put John, sorry, Sarah, I put John and my information up here. We hit 12:45. I see that there's one other question, so I'm happy to answer additional questions. So the question that was posed was, is it possible to convert a primary residence into a rental property after a period? Do 1031 exchange into 2 or 3 smaller rental properties and after some time take those replacement properties and convert it back to a primary residence? That is a multifaceted question, and that might be something that we need to discuss, Manny. But yes, you can convert a property from a primary residence into a rental property. And that sounds like such a specific question, Manny. Let's talk about that afterwards. But yes, you can certainly do that.
Yeah, that's kind of like a combination 1031, 121. If you have a primary residence that is that's appreciated in value over the course of many years, that you've owned it to more than 500,000, so now you're going to have to pay tax on the extra profit. You could certainly rent it out for the next 2 years before you put it on the market to sell, and then it would qualify as 1031. And as long as you sell it within 5 years, so that you've lived in it for 2 out of the last 5, then you can take your $500,000 exemption and take that cash off the table if you don't want to reinvest it. And then you can reinvest the rest of the money into exchange properties, and they can be multiple properties or one property. And then you can rent one of those out for 2 years and then move back into one of those after you've bought it as an investment property and kept it as an investment property for 2 years. So absolutely possible.
Yep. If there are any other questions, feel free to unmute. You can certainly put it in the chat. And we'll just wait just a couple minutes. And if there's nothing else, we can end the event. Like I said, our information, I'm going to put it back up on the screen. So our information is going to be back on the screen. Got a little.
I have another question, Michelle.
Yes.
Can you take two investment properties and roll those into one?
Love the question. Yes. So you can certainly consolidate, meaning you're selling multiple properties and you're purchasing one.
Okay.
And you can do it vice versa. You can sell multiple properties and you can, you can sell one property, buy multiple, where you diversify, or you can sell multiple and buy one, where you consolidate.
Where you consolidate.
Yep.
Are the timelines still the same requirement?
They are. They are. So when you're selling multiple properties, you know, you're going to try to line up all the closings pretty close together. That would be the goal.
Thank you.
How can you turn the new property from income to personal, and what about the deferred tax? So you're carrying your tax basis over, Ken. So you're bringing your tax basis from your relinquished property to your replacement property. So when you sell your replacement property eventually, you're going to pay the tax that you would have normally paid because your basis is much lower. So that's how that works. And changing your property from a rental to a primary residence, you're going to report that on your taxes.
Yeah, you just
Obviously,
need
you're
to,
going to.
you need to
Sorry.
rent it for 2 and then you can move into it. And then if you, the longer you stay, once you sell it, then you get a fraction of the primary residence exemption when you 1031 into a primary.
That's right.
Yep.
Repeat that again. So if you 1031 exchange your investment property, you're saying for the relinquished property after 2 years, if you then switch that to your primary, is that kind of the sequence of the order, the order that you just said? Can you repeat that? I'm sorry, I didn't catch the part about the switching to the primary.
Yeah, if you, when you know, you've got an investment property, you sell that and you exchange into a replacement property, and then you need to rent that property out for 2 years.
2 years. Okay.
Yep. And then you can move into it.
So in year 3, you're saying?
Yep.
Okay. And then let's say, and then, okay. And then, okay, so that would happen in year 3. And then let's say year 5, you decide to sell that now primary. You're saying that you would get the tax advantage.
You get 3/5 of the exemption.
3/5?
Yes.
Okay.
You live there for 3 and you own the property for a total of 5 years.
Okay, so 3 of the 5 year. Okay.
Yeah. So if you stayed there for 5 years, then you get 5/7 of the exemption.
Okay. Gotcha. Thank you for just helping me keep track of the time frame in terms of doing what in what year. Okay. Makes sense. Thank you.
Thanks, Christine. So John, Harry has a question for you. He said, I did not file depreciation for the past years. When I sell it, the IRS still recaptures. Is that what you meant? Will they recapture the depreciation regardless if he took it or not?
They will, unless you're going to do a 1031, and then unrecaptured depreciation doesn't get counted if you're doing a 1031. So there's no tax, no depreciation recapture tax, and no tax, capital gains tax, and no state tax if you 1031. But if you sell it and you have not taken depreciation, you're still going to have to pay tax as if you did. So on the portion that you should have depreciated, you're going to have to pay 25% instead of 15. So you're going to have a 10% penalty basically because of the fact that you could have taken that depreciation. That's why it's called imputed. It's imputed, just like if you don't charge interest to somebody, you're still going to have to pay tax as if you did charge them interest if you're making a long-term loan to someone. So the essence of I think the question was, am I still going to have to pay if I sell it outright and I'm not doing a 1031 exchange? Am I still going to have to pay a higher tax because of the fact that I didn't depreciate? Yes, you are. You didn't take advantage of the depreciation during the years that you could have taken it, but you could have taken advantage of it. So the IRS is definitely going to penalize you for it. You're going to have to pay that extra 10%.
That was a good question. Ken, the next question is, what if you never sell the new property, but you turn it into personal use? When do you pay the deferral tax? In the year you transition to your personal use? No tax will ever be required until you sell the property. So, I mean, you're saying that you're never going to sell that property once you turn it into a personal use. So you're not going to pay that tax. You are going to die with the property and your heirs will get the stepped up in basis.
It's the reason that real estate is such a beautiful investment.
That's
It's
right.
tax protected.
I have a quick question, Barb. Can you hear me?
Oh, hi, Barb. Barely, but yeah.
Okay. My question is this. I heard all of the records that, the calendar, we need to keep records, who was in there, what we fixed in, and Home Depot, etc. What about previous 2 years of my house that I've rented? Like, what kind of records? We do have records of rentals, but how is that, like, very important to have a folder with all the rentals in it, or?
I'm having a little bit of a hard time hearing you, but I think the question was what kind of records you need to keep for your rental. I mean, if you've been showing it on your income taxes and showing
that's
the rent.
right. It shows on the income tax. Okay, I got it. Yep, that answers it. Thank you. Yeah, I got it.
That's it.
Any other questions? Oh, I see one in the questions. Sorry. Lou, our fees, we typically charge a flat fee for just a standard forward state exchange would be $1,950. Now there may be fees if you have multiple replacements or multiple relinquished properties. There's going to be different fees for a forward reverse exchange or an improvement exchange, but that kind of gives you a little bit of an idea. Any other questions that we can answer for you? Our information's up top, and we are 10 minutes over our time because we had great questions today. So if you want to reach out to us, feel free. And, we're going to just disconnect when selling two properties. When does the 45 days start? 45 day will always start on the sale of your first property.
Closing.
But what did I say?
Sale.
Yes. So thank you.
Well,
so
I mean, some people might think that the sale would be at the time you sign a contract to sell the property.
the time you transfer the deed.
Right, closing.
Yep.
At the time of the transfer of the deed and the disbursement of the money.
That's right. Yep. Good. Are fees tax deductible? I mean, you're using if you're exchanging, you're using your exchange proceeds. You don't have to reinvest the closing the fees. So if you sell for $500,000 and you have $50,000 in closing costs, you really only have to find a $450,000 property. So yep. Will you send a copy of the presentation? We will be sending out the recording. If you want a copy of the presentation, just email me because I'm not going to send it out automatically. It's too big of a file. Any other questions? Well, thank you all for joining. I appreciate your time. It was nice to see many of you. And I look forward to working with you soon. Thank you.
Thank you.
Pleasure.
Thanks.
Thanks, John. Thanks, Sarah.
Thank you, Michelle.
Thank you.
Beautiful.
Bye now.